Hi, my name's Scott Dahl. Thank you for tuning in to another one of my podcasts. What we've basically done is we've gone from uncertainty to uncertainty. Now, I've felt that the market would rally through the election, which it did. If you go back to my previous podcast, Election 2024, I said, I think it's going to rally through the election. It'll probably rally through the remaining portion of the year. That's typically what happens. I don't see any reason why it won't, but I am going to show you a few things that I'm a little concerned about in this podcast. I want to start out by saying that we are in a secular bear market. We're in a high inflation, high interest rate, secular bear market. It's going to last for a long period of time. What we're experiencing right now is we're experiencing a bull market, a cyclical bull market and a secular bear market. These are very typical. And this could be strong for a year. It could be strong for 2 years. It's a great bull market, but it will end, and we're going to have volatility. We're going to have significant bulls and significant bears for a long period of time. It's a high inflation, high interest rate, secular bear market. It's going to be similar to the 66 to 82 period. It's not going to match entirely. It never does, but that's kind of the period that we're entering into from an historical perspective. And there's significant reason for that. It's time, which is a predominant reason, but you can see it unfolding. If you go back and look at, I have 3 podcasts up that will explain this. Secular bear market, that'll explain this long-term secular bear market that I believe we're in. It'll give you an idea of what to expect. The other one is inflation here to stay? That'll give you an idea of why I think that inflation is going to continue to move higher for a long period of time. Thirdly, is how the Federal Reserve affects the economy. That'll give you an idea of why interest rates the caps come off interest rates and interest rates are going to go higher. So we're going to see a significantly volatile bear market. Also, I think we're going to see volatility going into next year. Main reason is we haven't seen any this year. So we should expect that. And it typically is volatile the year after the election. So what's going on right now? Well, we're moving from uncertainty to uncertainty. The uncertainty was obviously the presidential election. We didn't know who was going to get into office, but now what's happened is President Trump's proposed policy changes. The economists they're coming out into the news. Remember, the market's emotional. They're coming out into the news and they're saying that it's inflationary, that he's going to put tariffs on imports. He's going to lower the personal tax rates. He's going to lower the corporate tax rates. They see this as inflationary. Also, we all know the tariffs could be posturing. So we just don't know at this point. There's a lot of uncertainty. Secondly, as the Federal Reserve has come out and they said, oh, wait a second, inflation's picking back up again. Remember, it's going to come down, but it's going to go higher. So we're going to see these moves, but over the long term, we're going to go higher. So they're saying, oh, inflation's picking back up. We might have cut too hard, too quick. We're going to be a little bit more data dependent now. They've changed their projections on cutting their interest rates. They're going to be more cautious. That's a big concern of the market because the participants that buy stocks, they don't like the fact interest rates are going higher because they feel like that's going to curtail or slow down economic activity. So please go back and watch those 3 podcasts. Technical analysis works because the market is a psychological mass. It's what all investors believe that the market or that asset is worth at that specific time. And we have a tendency to react on an emotional basis, particularly with our money. That's why you see these overbought situations, these oversold situations. It's emotion, and that's why we see the bubbles. And so technical analysis, it gives us a visual view along with using the price charts and other tools to try to determine what's going to happen because we've seen these repetitive patterns in the past because human beings we're repetitive in our behaviors. That's the reason why I like charts. Now, you don't want to ignore fundamentals, but for example, let's take Elon Musk. You don't want to ignore what he's saying or what he's doing that might propel his technologies or his stock price is higher. Again, I'm using him only as an example, but you want to look at the chart to see what the price activity is, and that'll help you determine whether it's going to go up or down, or it'll give you the probabilities in the future of where the price is going to go. With a fundamental analyst, what they do is they're basing it on the companies themselves and what they believe the companies are going to produce and their earnings. They're looking at their earnings going forward, and that's all fine and good. But keep in mind that, the stocks represent companies, but they're stocks, and this is what people trade on. This is what people pump their emotion into to try to make money. That's why fundamentals are important, but I believe technical analysis gives you a leg up because it has, in my opinion, from my 48 years of working with it, I think charts give you more of a predictability of where we're going to head. So with all that said, I want to look at a couple charts right now. What I've got up on the screen from Scott Brown, he's a fellow CMT, and he's got this chart. You've seen it before. The gold is the election years, and this goes back to 1928. This is typically what happens in an election year. You see a bottom in October, and right here is where we are right now. So this would give me a reason to believe that we're going to continue higher through this period in time. So what I've got up on the screen now is I've got flows into U.S. equities. And what this is the cash that's going into the stock market. So here is 2016. This is when last time President Trump was elected. And you can see here's ground zero. This is the election day. And we had significant cash going into the market, propelling the market higher. It's a little different this year. We've seen strong inflows. That's why the market's up, because there's cash going in buying stocks. However, what are we going to see from this point forward? Well, I would tend to believe that we're going to see continued fund flows into the stock market because there's a lot of cash on the sideline right now because of this election uncertainty. So I think we'll see more money going into the stock market, which would be a positive for the market. So let's look at some charts. This is the Standard & Poor's 500. You can see that here was the election pop right here. And then we started to sell off a little bit. You don't have to be concerned about this bull market until it breaks down below this trend line. So we've got plenty. We could see more selling because we could come down to this trend line. I mean, we've got some support areas here, support area here. We could come down here, but we don't want to be concerned about this bull market until we break through this trend line. So you want to be long and strong. We're in a continued uptrend. There's another index that everybody's familiar with. It's the Dow Jones Industrial Average. It's pretty much the same story. The Dow got a bigger lift out of the election. It's coming back down. It's not surprising that we're seeing some form of sell-off here. This, again, it looks similar to the S&P 500. You've got support here. You can see right here, that's where the market currently sits at that little X right there, 4320. And it's kind of right down on that support, a little bit below it, but it's fighting back today. You've got support here. You've got support here, but you could see this market come all the way down to this red trend line. Same story as the S&P 500. We're in a bull market unless it breaks this trend line decisively and stays down below it. Anybody that's watching these podcasts, they know I like the New York Stock Exchange because it's 2,038 stocks. So it could be a broader representation of what stocks are doing right now. You can see pretty much the same story. Significant support right here because of this top and this bottom. See that right there? Significant support there. But we could travel all the way down to the trend line. It's happened here, and it could happen again. But we're still in a bull market on this index as with the other two. This is concerning me. This is breadth. You know breadth by now if you've been listening to these podcasts. It's the number of stocks that are moving higher. So as the market goes higher, you want the breadth to go higher. You want more and more stocks to participate in the up move. That gives us more of an indication of continued broad, strong strength. Breadth is coming down a little bit. And what are we doing here? We're flashing up against this trend line, which is a concern. So if we get the breadth that breaks through this trend line, that could be a sign that the market's rolling over. However, we're not quite there yet. And it's expected, in my opinion, that you could see breadth go down and drop with the market as the price goes down. So we're obviously seeing a sell-off. More than likely, it's an overreaction. We don't really need to be concerned until we travel significantly below this trend line. So now what I want to do is I want to talk about one more thing. I want to talk about, again, fundamental versus technical analysis. So I've got what the fundamental analysts at the major wirehouses, at the big companies, at the big research firms, at the banks, what they're thinking about. And remember, they're basically fundamental analysts. So what they try to do is they try to project earnings in the future based on a lot of different variables. But fundamentals are important, but I like to look at that price on a visual nature because I think that gives me more of an indication of what's happening with the individual investors from an emotional standpoint and their input into the market. So at the beginning of 2022, the median year-end forecast for the Standard & Poor's 500 was 5,000. The index closed at 3,839. At the beginning of 2023, the median forecast for the S&P 500 was 4,000. The S&P 500 closed the year of 2023 at 4,770. For 2024, the median forecast for the S&P 500 was 4,650. The index is currently right around 5,900. There's an analyst with Morgan Stanley. He started the year stating that he felt the index would be down 10% from 2023 levels. Well, obviously it's not. The index, the S&P 500, is significantly higher. He just came out with the projection for 2025 of S&P 500, 6,500. BMO, another large investment firm, their analyst came out with an estimate for 2025 as 6,700. So I've given you the statistic statistics here of what these fundamental analysts are believing that's going to happen to the market. Obviously, they've been decisively wrong for several years now. I'm not denigrating their work, but what I'm saying is maybe it's time to fade those fellas. So what's got me concerned is the fact that they're looking for significantly higher prices next year. Now, I will tell you this, that if you have a positive election, over the next 12 months, and all the way back to 1928, you will see an average return over that next 12-month period of 9.5%. So that's pretty good statistical evidence that we're going to go higher over the next 12 months. No guarantees, but that's what's happened in the past. That's a probability, only please expect significantly heightened volatility. But volatility can be your friend if you manage your assets properly and you know when to reduce risk and when to add risk. And that's something that I'd be happy to do for you, basically through my tools of technical analysis. So if you want me to take a look at your portfolio, make sure you're positioned properly, I'd be happy to do it. It's 949-497-6366. DahlCapitalAdvisors.com. You can reach me at scott@DahlCapitalAdvisors.com, or email me if you have any questions, and look forward to looking at this market here in the near future. So thank you again for tuning in.